because this will be a presentation a bit on the longer side. Okay, go ahead, Ronak.
All right, yeah, just go to the next slide. All right, so before we get into it, pretty much a recession, like the 2008 recession, we need to know what a recession is. And before we need to know what a recession is, we need to know what a business cycle is. So the business cycle essentially refers to the ups and downs in the economy. And that's pretty much what you're looking at right now in the graph. Now, in the short run, which is like the squiggly line, the economy alternates between the upturns and downturns as measured by the three macroeconomic indicators of employment, price changes, and short-run economic growth. Now, as you can see, there's some like words being labeled in this graph, and that is actually sort of referring to the divided four phases with the expansionary, peak, contractionary, and trough. But for now, we will be focusing on the contractionary section. Now, this phase typically occurs after a period of economic expansion. In this phase, real output in the economy is decreasing and the unemployment rate is rising. As the contraction continues, inflationary pressures subside. The later stage of the contractionary phase is also called a recession. Now you might be wondering, how do we know if we know or prepare if we are in a recession? There is actually no single way to predict how and when a recession will occur, but aside from the 2 consecutive quarters of GDP decline, economists assess like several different metrics to determine whether a recession is imminent or already taking place. There are actually some generally accepted leading indicators of when a recession may occur, which I'll post in chat. Now, if we can go to the next slide. So essentially what happened. So this is pretty much the aftermath of what happened of the housing crisis. $6.9 trillion worth of investors' money was lost. $3.3 trillion of home equity was lost. And this is trillions of dollars, by the way. And $10.2 trillion in total loss during the recession. So in short, I don't want to get too much into it because we're going to be talking about this later, but millions of American homeowners found themselves pretty much owing more on their mortgages than their homes were worth. The Great Recession that followed cost many of their jobs, their savings, or their homes.
All right, so now we're going to be getting into the causes of the recession. So we're going to break this down in a sec, but for now, you guys should need to know that the biggest reasons for the crisis were the subprime mortgage rates, the oil price shock, and then the CDOs, as well as the credit rating agencies, which all kind of led to the overvaluation of houses and led to that bubble bursting in 2008, 2007. And after that, we're going to talk about the aftermath of the effects of the financial crisis and how the government stepped in to kind of relieve the pressure on the economy.
Okay, so one of the main reasons for the Great Recession was deregulation in the financial industry, which led to banks trading derivatives. And then when the value of those derivatives fell, banks stopped lending to each other, and then it created the financial crisis. So the Glass-Steagall Act of 1933 was a law that could have actually prevented the crisis. It was passed by Congress after the Great Depression to stop bank runs, which is when clients withdraw their money from the bank because they don't trust it. And they did this by stopping banks from selling more risky securities to lower the risk of losing customer funds. But then in 1999, Congress passed the Gramm-Leach-Bliley Act, which completely overturned the first one, the Glass-Steagall Act. And this allowed banks to use deposits to invest in derivatives. And then it also prevented the US Securities and Exchange Commission, which is the government agency that regulates the buying and selling of securities. It prevented them from regulating the investment banks. And then the last one, the Commodity Futures Modernization Act, also prevented regulation of derivative trading. And then another reason for the recession was the Fed lowering the value of money. So in the early 2000s, the Fed lowered interest rates to cheapen money. This makes it easy to get a loan, but it also created household debt and limited regulation in the industry, as I talked about before. So in that chart on the bottom, you can see how the interest rate drops from almost 7% to 1%. And remember that the Fed usually aims for a goal of 2% inflation.
All right, so now let's get into the meat of it. Subprime loans and mortgages. So subprime, as the name implies, are loans made to unreliable, financially unstable borrowers so that the money would collect interest and lenders would make a lot of money off it. These borrowers are usually have low income or no income in some cases, as we'll see in a second, and have very poor credit history with FICOs below 550. FICO, by the way, is like a credit score, and good is considered 670. So you can imagine 550 is pretty poor. Obviously, the lender makes money when the borrower pays them, but when the borrower defaults or doesn't pay their loan, they get no payment and they lose money. And we'll see why this is so important in just a little bit. So poor borrowers, they actually take out mortgages at an adjustable rate. So what that means is that they have this low teaser rate for the first 2 years, typically, somewhere in the range of like 1 to 3%, I'd say. And then those jump after that 2 years, a higher rate jumps in, and it's based off like the current market standing. And usually it's around 18 to 20%, which is quite significant, as you can imagine. And being that these people are already risky borrowers because, you know, their income and credit history, they're pretty much done for once that rate hits. However, and as obviously as you can imagine, the rate becomes higher because there's also a greater risk of default. And so in the second quarter of 2007, which is when we started to see these adjustable rates kick in, subprime loans made up 14% of total mortgages. And while that may not seem like a lot, what actually ended up happening is that because so many people defaulted on their subprime loans, the value of homes actually decreased across the nation, because when a bank forecloses a home, neighboring houses also lose their value as well. So pretty much even people who were not subprime, did not have subprime loans, actually lost value in their home. So basically, too many borrowers took loans that they simply could not afford. And because housing prices were rising so quickly up to 2007, they were able to refinance, and also they could pay off their loan by selling their home. But once those homes stopped rising in value, they could no longer refinance and started defaulting on their loans. This is a cool, pretty funny comic, pretty sad at the same time, that kind of illustrates how kind of bad lending practices were. So as you can see, the guy saying, look at that guy, no job, no initiative, no future. And then the other guy says, well, he's also our best customer. So this kind of illustrates something also known as a ninja loan. So ninja loan, which stands for no income, no jobs, no assets, was a form of a predatory loan, which was given to like undocumented workers and such, who didn't have to provide any sort of documentation. They didn't have to provide any source of verify any source of income and stuff like that. And as you can imagine, those people are not going to pay back their loans. And this is the important part that kind of what made it had greater economic ramifications, is that they were packaged into something called mortgage-backed securities. So MBSs are pretty much like a bond, in that they're kind of like a pool of mortgages. Let's say we take about 100 mortgages from a neighborhood, and obviously these people are making payments on their mortgages, so that's kind of the return you get when you invest in a mortgage-backed security. And obviously, because it's mortgage, you have to provide that kind of capital for the borrowers to have, so you pay for that to get a yield in return. So these mortgage-backed securities obviously consisted of thousands and thousands of mortgages. And as we'll see, subprime had a devastating effect on mortgage-backed securities as well. Okay, and now let's talk about CDOs. So CDOs, which are insanely complex, they're also known as collateralized debt obligations, are pretty much a variety of debt that's made up of bonds, mortgages, etc., any form of debt. And they're packaged into classes called tranches, which means a little piece of something in French, based on risk. Which is obviously determined by the credit rating agencies, which we will see were extremely corrupt and also played a significant role. The term collateralized, if you're wondering, comes from the fact that there's the promise of repayment comes from the collateral itself. CDOs were sold to investors based on the chances of risk, with higher risk meaning higher yield, lower risk meaning lower yield. And going into like a kind of a brief history of CDOs, they were actually like formulated in the late 80s by the former investment bank Drexel Birmingham, which is no longer a thing, where Michael Milken, aka the junk bond king, kind of like ruled. They created these CDOs by assembling portfolios of junk bonds, which are pretty much like really bad risky bonds, which are pretty similar to the mortgage-backed securities and or mortgage-backed securities during like the housing crisis. And pretty much they were on any type of debt, on automobile loans, student loans, credit cards, aircraft leases. But then they started to kick off in 2003 and 2004 when they were pretty much a collection of mortgages. What ended up actually happening is that these banks, whenever a mortgage-backed security would not sell, like a poorly rated one, they'd collect a bunch of pieces from them from different mortgage-backed securities and put them together into a CDO. And suddenly they go from being rated triple B, which means or from Bs, which is like really bad, high risk of default, to AAA rated suddenly because they convinced the rating agencies that they were diversified, when in fact they were not, because they were pretty bad loans. Okay, yeah, that's. And continuing on CDOs, so as Colleen mentioned, I believe, or Gordon, CDOs are derivatives, which means they are a financial instrument that derives its value from an underlying asset. Options are also derivatives, as are futures, but CDOs are much more complex versions of those. The underlying assets in CDOs were the loans that were pulled together and then sold by the original lenders to hedge funds, other banks, pension funds, et cetera, aka the investors. And what's really, the CDOs themselves weren't that bad in all honesty, but what really set it off were these synthetic CDOs, which are even more complex than CDOs. And they pretty much allowed bets on the CDOs themselves. And they kind of acted like a CDO, but really what it was that they were, okay, yeah, I'm just not gonna talk about that. Never mind. So basically, what a synthetic CDO did is that they kind of were on the opposite side of credit default swaps, which Cassie will talk about in a little bit. Because synthetic CDOs started coming up because there were fewer loans being made, because there are a limited amount of loans you can make, because there are a limited amount of homes there are. And thus those are starting to dry up. So the investors and banks were looking for more ways to kind of make more money and make more bets. So they started leveraging their bets. In other words, betting money on the success of the underlying asset, which in this case was the mortgage-backed security. So every like $1 that was loaned out in a mortgage, there was about $200 to $300 on bets on it through synthetic CDOs. And pretty much, this quote's pretty accurate. It turned a keg of dynamite, aka the subprime loans, into the financial equivalent of a nuclear bomb. And what it really did is that it led to the risk of default spreading beyond the original lenders and borrowers to the broader financial system, because pretty much everyone was investing in this, especially people in Europe, Germany specifically. It's pretty weird, I know. And warning sign for the past, they have experienced a resurgence as investors are looking for high yields and are turning to these investments once again. And banks and investment firms are responding by hiring credit traders who specialize in this area. So do know that these are still around, maybe not as big as they once were, but they still pose.
Okay, so now we're going to talk about the government response to the financial crisis. Specifically the US response, because although Ronak mentioned, Europe and other people from other places did contribute to the crisis and mostly, mostly lost a lot of money in the crisis, but it's specifically the US government's response. And so I think you guys have heard a lot about people saying like, oh, the government bailed out the banks or bailed out the companies, or like the government took the loss or taxpayers took the loss. But you might be wondering what this actually means, so we'll be explaining it in the next couple slides. Okay, so first off, let's get a little history on Fannie and Freddie. So Fannie Mae and Freddie Mac are basically two entities that began as a child of Congress. So it was first chartered by Congress in the 1900s and later privatized. So it didn't start off as an independent company. And so Fannie and Freddie were basically government owned, and then they were privatized, so they became owned by stockholders. And basically what they're supposed to do is they buy the mortgages from banks, so these subprime mortgages, aka basically bad loans. And what they do is they repackage them into MBSs, like Ronak was talking about, and then they sell these MBSs to investors. So basically, different people beyond just the banks are taking on a lot of risk. And this is just a kind of a web of risk that a lot of people are part of. So Fannie buys a lot of these mortgages from larger banks and Freddie buys them from smaller banks, but they're essentially like the same purpose. And so what Fannie and Freddie are essentially supposed to do is be the ones who buy these mortgages, thus giving more money to the banks and thus enabling the banks to loan out more money. So this is important because it actually expands or it enables the banks to loan out even more money, which obviously increases the risk and makes them fall even from a higher place than they were before after the crisis. So the advantage to Fannie and Freddie would be that they were still tied to the government even though they were privatized. What that means is the government was still like supposed to bail them out. The market, people in the stock market, and just like the housing market in general and banks, they thought Fannie and Freddie were basically invincible because they had the government backing them up. So they basically let Fannie and Freddie borrow a lot of money. And what happened as a result was Fannie and Freddie eventually failed, making the rest of the system fail as well. And Fannie and Freddie is just one small portion of it. There's a lot of debate over how much of a factor the failure of Fannie and Freddie contributed to the actual crisis. But Fannie and Freddie were basically what the government used as one tool to fix the crisis. So what happened was the government bailed them out by basically buying shares of them and doing this process called conservatorship. And it's basically when they buy shares out of them and they bail them out, and they basically support Fannie and Freddie in order to help like the rest of the system. And I think a lot of banks were bailed out in this way, but beyond that, a lot of banks were also bought out. So for example, with Bear Stearns you see on the screen, it was bought out by JP Morgan because JP Morgan took out a loan from the government. So everything was basically merged, bought out, or bailed out in this process. Okay. So moving on to AIG, which is the American International Group, Financial Products. So AIG was a really big company. In fact, most people call them too big to fail, which is something that Alan Greenspan, a later Fed chair, said was basically pretty stupid. He said, if they're too big to fail, then they're too big in general. And so what happened with AIG is kind of similar to Fannie and Freddie in the sense that everyone thought they were invincible, so they kept relying on them. And the problem with that is that AIG was not invincible, and it played a really central role in the crisis. So what AIG did was basically this thing called credit default swaps, as Ronak was talking about. So what happens is banks obviously know that they are taking on some risk when they loan out money. And you might be thinking like, wow, they're really dumb for loaning out so much money to a bunch of really risky people. Well, yeah, they were, but they also thought they were backed up by people or groups like AIG. So AIG insured the banks. So the banks were the customers sort of AIG. So what AIG did was it basically did this thing where it swapped credit, like the poor credit of the customers with the good credit of AIG itself. So they said, I'll insure you, so why don't you loan out more money? So banks basically were encouraged to loan out even more. But the problem with that is that AIG insured banks to the extent where they couldn't even cover the banks anymore. So when the housing crisis basically happened and people defaulted, houses foreclosed, banks shut down, people took out money from banks, all of that good stuff. What happened was AIG couldn't insure the banks because so many banks had failed and wanted insurance. I mean, AIG didn't have enough capital to cover all of that insurance. So AIG itself also failed. And it basically ran out of money on the same day that the Lehman Brothers collapsed, which is September 15th. So then the next day, the Fed basically bailed out AIG and took 80% equity, which means ownership, right? Like into a company. And the whole problem with this is that AIG was also too ambitious, just like the banks were. The banks were sort of like the ones who were helping the customers by lending out mortgages, right? But the AIG was supposed to help the banks by insuring the banks. But AIG also took on too much risk and was too ambitious, which basically helped further the collapse of the entire system. Okay, so obviously the Fed and the Treasury did do stuff to fix the crisis. And so the Fed at this point, what they did was they tried originally to lower the federal funds rate. So if you guys are in econ, or maybe you're not, but we did talk about this a couple presentations ago, the federal funds rate is basically the rate at which banks lend and give out, loan and lend money from each other. So basically, there's a specific, there's a required reserve ratio, right, that banks must have within their system so that they can give loans out to other people, or they can like give money back to people, because they have to have some reserves. Unfortunately, what happens is the banks have that reserve, and sometimes they don't have enough money, and they realize that they're below the required reserve ratio. So what they do is they borrow from other banks, which generally works out pretty well. And what the Fed can do is actually control how much it costs, like the interest, how much it costs to loan or lend out money to another bank. And when they lower this rate, it's basically like an interest rate. And when they lower it, it's easier to borrow money, and people want to borrow more money. Or in this case, banks want to borrow more money. This is basically the same thing as an interest rate to just a random customer who would find that the interest rates are lower. It's easier to borrow. Let me borrow more. But what happened with this was a liquidity trap, which is basically when the interest rates and the federal funds rate are already at zero, and you obviously can't lower it lower than zero. So what happens is they can't use monetary policy. So what the Fed has to do is usually turn to fiscal policy. Well, not the Fed, sorry. What Congress would do would be turn to fiscal policy. And what the Fed would do would be to turn to quantitative easing, which is a topic we also covered a couple weeks ago. We'll give you a refresher in a second, but as a reminder, quantitative easing is a specific technique that involves the tool of open market operations. So you can see at the chart over here that, as Colleen was showing you earlier, the federal funds rate fluctuates a lot and is then essentially ends up around zero, which means that the Fed is basically has its hands tied. And also the Fed expands its balance sheet to include $4 trillion worth of a bunch of securities. Okay, so quantitative easing, as a refresher, is basically when the central bank, the Fed, decides to buy or sell more securities, which in this case are bonds. So what it essentially does is if it sells bonds, then it's taking out money from the system, because the banks have to give money in exchange for the bonds. That's usually a contractionary policy, right? Because it's not expanding the economy, it's usually contracting it, or it's contracting output. But what happened in this case was the Fed had to buy bonds. When it buys bonds, what happens is it increases the money supply because it's exchanging the bonds for money. By increasing the money supply, you decrease interest rates. And like we said earlier, if you decrease interest rates, it's easier to borrow and people borrow more. And this is really good for the economy. It basically stimulates the economy, makes people buy more, consume more, which adds more jobs to the economy. And it's overall a good thing in this case. Okay, so beyond this, the Treasury also did some stuff. So 2008 was basically the transition year from President Bush, Republican president, to President Obama, Democratic president. So they definitely had different methods of trying to, strategies to fix the financial crisis, right? So you see with the Emergency Economic Stabilization Act of 2008, that President Bush and his Treasury Secretary basically used this act to buy troubled assets from banks. So this is another way of bailing out banks. And so this basically is called the Troubled Asset Relief Program, or TARP. And what TARP does is it bails out big banks, and it also bails out automakers, homeowners, and a bunch of different groups of people that lost a lot of money. What they also did was they nationalized failing companies. So you see the big three auto, GM, Chrysler, and Ford. They were failing, and what the government did was basically turn them from private companies to national companies. So if you recall what I said earlier, Freddie and Fannie were two, not companies, they were entities. They're basically bureaucratic agencies. And what happened was they were originally from the government, and then they became privatized to become stockholding companies, right? And then the opposite happened to these big three auto companies, where they started off completely private, and then they became nationalized. Okay, and then after President Obama took office, he started the economic stimulus package of 2009, which is really similar to the CARES Act and all the stimulus packages right now in the pandemic. So you can see a lot of parallels between the two. Generally, they are more supported by, larger stimulus packages are more supported by Democratic presidents or politicians rather than Republican. And we can go more into this if we ever have a specifically coronavirus themed presentation. But essentially, it's just putting more money into people's hands with like stimulus checks. I think we did a couple warm-ups on this, so hopefully you remember that. Oh, and eventually the recession did end in July 2009, even though a lot of these programs still exist today. For example, Fannie and Freddie, they still exist today, and they're still in use. So basically, Fannie and Freddie, they provide mortgage relief to a lot of people who find it difficult to pay back their mortgages during coronavirus. Okay. Oh, and one last thing, it's not on the slide, but there is one more law that was passed by President Obama and his administration, which is the Dodd-Frank law. And essentially what this does, it's not directly related to anything money-wise, but it increases the transparency and prevents banks from taking on too much risk. And this is pretty important because to this day, we still don't know a lot of the balance sheets of the banks. So we still don't know how much risk they really took and how much they really failed and how much they couldn't pay back. So this increase of transparency hopefully prevents huge recessions that stem from bubbles, right? Because coronavirus obviously caused a temporary recession as well, but it wasn't necessarily caused by a bubble, really. It was by coronavirus.
All right, so now the aftermath and the effect on the economy can be pretty much summed up in 5 words by George W. Bush. We got a big problem. So if we go to the next slide, I will send you guys a link about like a great flow chart that pretty much describes and sums up the effects of the crisis for you visual learners. But essentially, the crisis was like the worst U.S. economic disaster since the Great Depression. In the U.S., the stock market plummeted, and like I said before, wiping out nearly $8 trillion in value between late 2007 and 2009. Unemployment climbed about like 10% in October 2009, and Americans lost over $9.8 trillion in wealth as their home values plummeted and the retirement accounts vaporized. Now, from a global perspective, the Great Recession led to a loss of more than $2 trillion in global economic growth, or a drop of nearly 4% between the pre-recession peak in the second quarter of 2008 and a low hit in the first quarter. In the next slide, we'll talk about why it's important to learn about the recession today is that it sort of reminded the modern society about the dangers of security and the necessity of risk aversion. I think generally economists agree that the financial system today is safer. Like Cassie mentioned, we have the 2010 Dodd-Frank Act, which pretty much put up new guardrails around the banking sector. The country's biggest banks must now undergo periodic stress tests to prove they could survive another crisis and draw up living wills so that they could be dismantled in an emergency without requiring a taxpayer bailout. One thing to add on to what Cassie said is that by 2018, some portions of the act has been rolled back by the Trump administration, although an attempt at a more wholesale dismantling of the new regulations failed in the US Senate. Those regulations are intended to prevent a crisis similar to the 2008 crisis from happening again. So this doesn't mean that there won't be another financial crisis in the future.
So going into why it's important to investors that we look back to the 2008 crisis is we're starting with political leadership and its importance. So there's an argument that the crisis was originally stemmed from Clinton era policies, especially the affordable housing goal, but really the focus is on the Fed and how they helped the economy recover from the recession. Additionally, fund managers didn't always do their homework. We talked about the credit rating agencies. So essentially what had happened was the agencies overrated certain securities and certain investments, which then people would blindly invest in, thinking that the AAA or AA plus rating, whatever rating that the agency gave to a certain security, they thought that that would be a valuable investment just because of these companies, Standard & Poor's, Fitch Ratings, and Moody's, because of their ratings. Additionally, we talked about rationality versus irrationality. I know Cassie covered the too big to fail aspect of that, where people thought that no matter what, these big banks and these huge corporations were going to be invincible, which it turns out they weren't, especially when AIG realized that while all of them did fail, they didn't have enough capital to expend those insurances. So before we leave off, I'm going to end off with a quote from John Galbraith, and he said, "There can be few fields of human endeavor in which history counts for as little as in the world of finance." By the same aspect, this historical event is, as we can see, it is a huge impact on everyday occurrences and even on the coronavirus pandemic. And then I think we can dive into some discussion about how this event compares with the current recession or the previous recession from last year.
Yeah, and then finally, we did have a guest speaker, I think last year or 2 years ago. I think it was last year, actually. If you guys were in this club last year, Sumant Gupta. He was basically an expert on the financial crisis, and he talked a lot about his experience as well as the causes and effects and everything that we talked about today. But since I wasn't really sentient around that time, 2008, we are all saying it from our own research or from what we were told from our parents. So it's interesting if you want to talk to your parents about what happened, assuming they're not traumatized, because a lot of people did lose a lot of money on this. But if you're open to it, you could talk to your parents or any older adults about what happened during the crisis and what they thought about it as well. Okay. Are there any questions? Yash, I am actually not sure. I don't think so. My officer team, anyone can correct me? No? Okay. Yeah, there weren't any. Good question, though. And the pandemic recession, like Gordon mentioned, was actually really, really short-lived. It was like the shortest recession in history, I think, or at least modern history, because immediately the economy bounced back. And a recession, again, is difficult to gauge, right? Because it's not purely based on the 2 quarters of GDP, but it involves a lot of factors like unemployment. And they basically deemed that it wasn't a recession anymore. So long answer to that question, no. Any other questions? Okay, in that case, a couple announcements before we go. So the first thing is that you guys need to know next week we don't have a club meeting because there will be a Street Fins inter-club meeting. I think we sent out this form last time, but I'll send it in the chat one more time. Hold on. Basically, it's going to be a speaker from the SEC. I hope that link works. If not, I guess copy and paste it into your own browser. But essentially, he's from the SEC. And if you want to ask any questions, there's a Google form that you have to sign up for to get the link to go. But also, if you want to ask any questions, you can send it in the form. I think that it'll be from 3 to 4 next Wednesday. So during our normal club meetings. So you don't have to like make any random other time in your schedule. But because of that, it'll replace our usual meetings. And then the week after that, we'll have a little activity that will be run by me and Colleen. So anticipate that. It'll be sort of similar to the scavenger hunt. And then the week after that, we'll probably return to more presentations. But if you guys have any topics that you guys really want to hear, I think like with GameStop, that was pretty spontaneous. Obviously, I did not plan on a presentation. We kind of just like scrapped it together over the weekend. But if there's anything you guys really want to learn about, just like let us know with your email or reminder or anything, and we'll try to make that happen. Okay. In that case, we're pretty much done for today. Oh, I'm still recording. I guess I don't make the YouTube video. In any case, thanks guys. That's pretty much it for